Howard Schilit, Financial Shenanigans, How to Detect Accounting Gimmicks and Fraud in Financial Reports. Deceptive financial practices can result in tremendous loss for investors, who often struggle to detect such trickery. Financial Shenanigans, How to Detect Accounting Gimmicks and Fraud in Financial Reports by Howard Schilit divulges how companies occasionally misrepresent their economic performance through dubious accounting techniques. The book identifies 30 accounting tricks and discusses the rationale behind such unethical moves. It also provides insight into reading auditors' opinions, recognizing early warning signs, and detecting gimmicks related to acquisitions. This summary will guide you through crucial information to identify accounting fraud and help you make investment decisions wisely.
Unveiling the Deceptive Accounting Practices on Wall Street. In recent times, Wall Street has been rocked by scandals resulting from deceptive accounting practices, which have left investors high and dry, losing billions of dollars. The Center for Financial Research and Analysis, CFRA, has identified 30 unethical techniques, grouped into 7 categories, used by dubious companies to deceive investors. These fraudulent practices range from minor accounting estimates to bogus revenue recognition. There are 2 strategies, both aimed at manipulating earnings, inflating or deflating them. Underestimating a company's financial position can lead to favorable future performance projections, hence the decision to deflate earnings. Unscrupulous managers have various options to choose from when it comes to accounting methods, and while some choose the one that best reflects their firm's performance, others opt for strategies aimed at exploiting the system. The opportunities to commit such financial shenanigans are numerous, with many executives having a vested interest, given that bonuses and stock options are usually tied to a company's financial profile. Furthermore, the chances of getting caught are slim, with unaudited quarterly financial reports presenting fewer checks and opportunities for manipulation. Experts recommend more scrutiny around revenue inflation shenanigans since these can have severe implications compared to those that affect expenses. Therefore, it is crucial to evaluate a company's reporting while being cognizant of any misguided management incentives. Executives often prioritize the bottom line, making it vital to question the validity of a firm's numbers. Financial report distortions. Financial reports can be distorted under certain circumstances, such as weak oversight environments, closely held boards of directors, and lack of competent independent auditors. Be wary of companies with executives of dubious character, facing competitive pressure or experiencing a slowdown in growth. This is especially true for previously high-flying companies. For struggling companies, be cautious of their inner workings. Keep an eye out for early warning signs to avoid being misled by manipulated financial reports. Auditing for investors. Auditors use opinion letters to give a clean or qualified view of a company's financial statement. An absence of an audit committee or compromised members can signal red flags. Investors should be wary of companies with qualified opinions and the mention of going concern. Compensation structures that prioritize profits can encourage accounting fraud. Companies on the NYSE are mandated to have audit committees, but this isn't required for most publicly traded companies. Tricky ways financial reports are distorted. Whether or not you are into investing, it is essential to be aware of the tricks some company managers use to distort financial statements. It turns out that keeping track of revenue is not as easy as it sounds, and investors may need to examine the company's balance sheet carefully to stay safe. This passage highlights 9 distinct methods of book cooking, ranging from recording bogus revenue to special charges and expense shifting strategies. Investment gains might only be one-time gains such that counting them as income may not be a wise strategy. In the long run, failure to report future liabilities accurately may lead to a loss of credibility. Allowing reserves to be suddenly counted as income or creating feigning rebates may also put the company's reputation on the line. Unveiling corporate scammers. Learn how to identify potential corporate scammers through online financial report screening using various databases. Discovering financial scams among corporations can be challenging, but thanks to multiple internet databases, uncovering malpractice has never been easier. These databases provide assistance in filtering data to check for any downside. With Compustat by Standard & Poor's and FactSet Corporation being two of the most commonly used databases, scrutinizing a company's financial reports can be a breeze. These databases allow users to filter companies that have the sharpest decline in cash flow or the largest year-to-year sale decline, among others. Learning how to use these tools can ensure that individuals are equipped with the knowledge to unveil corporate scammers. Pitfalls of Acquisitions. The lure of acquiring another company to accelerate growth can be risky for investors, as it can be a breeding ground for fraudulent practices. The book highlights several techniques often employed by companies to mask the poor health of the purchasing company during or after the acquisition. These include taking massive write-offs before or after the deal, transferring losses to another time frame, and releasing reserves created from write-offs. The book advises investors to be wary of companies that use aggressive acquisition behavior to drive sales up artificially. Enron's warning signs. Enron's cautionary tale warns us to be careful when companies make significant changes in their business models. It's especially true when they switch to more complicated models, such as trading on future energy contracts. Enron's use of special purpose entities, SPEs, was a red flag. They were off-the-books facilities that could hide profits or liabilities, and Enron did not disclose enough about the purpose of these entities. Preventing financial shenanigans. To prevent the recurrence of corporate financial scandals like Enron, various parties must be involved in modifying the existing system. Those who determine and interpret laws, and set professional standards must establish clear parameters on proper financial accounting and reporting standards. Internal auditors should report directly to the audit committees of their boards, and auditors should be held more accountable for detecting fraud during an audit. Companies should be required to have auditors review their quarterly financial statements before they are released to the public, and investors should be wary whenever a company dramatically changes its business model. While financial shenanigans may never be entirely prevented, certain steps can and must be taken to restore corporate credibility, including improving auditor and investor training, re-evaluating the incentives to manipulate the numbers built into executive compensation packages, and creating active, independent oversight from the board of directors.
Howard Schilit's Financial Shenanigans serves as an invaluable guide to identifying and avoiding financial fraud and manipulation by companies. The book reveals the dark secrets of accounting gimmicks and the reasons behind their devious use. It discloses the early warning signs of financial fraud and emphasizes the importance of careful assessment of company acquisitions. The author also highlights the need for strict oversight measures, accountability of auditors, and enhanced training for investors. With the knowledge gained from this book summary, you will be better positioned to safeguard yourself against financial deception and make informed investment decisions.